research anymore. If you
Yeah.
were to do research, what would you do nowadays? What interests you if you think about it?
I mean, to me, I think research, and I don't do academic research anymore, which is now part of the reason for that is it's extraordinarily, narrow focus, because that's the way you get published, and you lose perspective, and it takes years to get published. So by the time you actually get published, nobody really cares. So that's part of the problem. I mean, somebody's got to do it. I'm not saying it's not valuable, but for me, it's not what interests me. So I dabble in whatever interests me that week. Anyway, people are almost here, so thank you for joining me, and thank you for sending the numbers in. I was happy to see everybody's numbers were pretty much in. So what I thought I'd do today is actually use the numbers you sent as a way of taking a journey through the entire class. So starting with the very first class. So think of this as a review session wrapped around your project, wrapped around what's coming on the final exam. So now let's get the process started. Now, as you went through this project, I mean, I could have told you this up front, but it doesn't quite register as you wrestled with your company. Here are some things I think we all share. First is, I hope you realize how few facts there are on the ground. Even the numbers that you think are facts, when you take a closer look, become opinions. For instance, people talk about accounting numbers as facts. And as you looked at your company's accounting reports, annual reports, financial statements, 10Ks, you realized very quickly that even those numbers shifted. You used 3 different services, you got 3 different numbers for the same input. The second is the real world is a messy place. It's a messy place in the sense you always have loose ends. Just when you thought you were done, a new report came out from your company, an acquisition, a divestiture, your company keeps shifting. And that basically means you're never quite done in corporate finance. You think you got your company nailed down for the moment, but that shifts very quickly. Third is, I know that I made you use some of my models. Part of the reason for that is I didn't want you to spend your time learning Excel over the course of the semester. So if you have time over the summer and you want to build your own models, I'd strongly encourage you to do it because it's good to build a model from scratch. That said, though, all the models do is take your numbers and feed them back to you. Especially when you got to the valuation phase, some of you did not like the values you got for your companies. And I will paraphrase the emails I got over the last week. Why is your model valuing my company at such a low number? Or why is your model valuing my company at such a high number? And part of the reason is the model looks like it's valuing the company, but the reality is it's taking the inputs you give it and feed it as output. You made the choices as inputs, and the output just reflects that. And finally, now this needs to be said anyway, which is change is the constant. I mean, be glad that you took this class in spring of 2021, not spring of 2020. Spring of 2020, you had COVID raging through the middle of the semester, and people were completely off balance. But that's something that's going to happen. It's not in your control. So that said, let's look at who you analyzed. I think the most analyzed company in this class was Netflix. There were 6 people, presumably in 6 different groups, who valued Netflix, followed by Lululemon. Don't ask me what it is about Lululemon. It's just people have this fixation with this company, which is vastly out of proportion to its market value, its profile. Peloton Square, so Lululemon, Peloton and Square, 5 people did. IBM, Amazon, Costco, Shopify, and Zoom were all done by 3 people each. Now, one question I often get asked is, why do I not make sure that only one person picks a company? Why does it matter? 6 of you could be analyzing the company as you did Netflix, and your numbers are all going to be different. It's almost a given. You think you're doing the same thing. Everybody comes to an agreement. I'd even show you the optimal debt ratios and the valuations, but no 2 analyses of any of these companies came up with exactly the same numbers, and no 2 ever will. And that's actually testimonial to the fact that I could get, you and I could have the same raw data on a company. but the analysis we do on that company can lead us to very different places. So let's start at the very beginning. I spent the first 4, maybe 5 sessions talking about corporate governance, which is just a fancy word for where in this company does the power lie. And I used the linkages between different groups to kind of illustrate the conflict of interest that embed the modern company. I looked at stockholders and managers. And I argued that in the real world, stockholders have little control over managers. And what do managers do? They often put their interests above stockholder interests. We talked about lenders in the company. And lenders, they lend money to a company, they don't protect themselves, will get ripped off. And why that leads to, the potential conflict of interest leads to agency problems that later play out in how much you borrow. We talked about managers in financial markets. I don't think I took a strong position that markets were rational and efficient. I said we often assume markets are rational and efficient, but I think I was pretty open about the fact that markets often do strange things. Remember the Elvis Presley test? You convey information to markets, sometimes you mislead markets, you hold back on information, and markets don't always behave rationally. And finally, we talked about social costs and benefits. I don't want to refight the ESG fight in the last session, but as you go through the summer, I want you to think about, if you want companies to be good, how do you make sure that that happens? And it's my conviction that ESG is not going to get you there, because it's more, in my view, about sounding good than doing good. And if we really have the shared objective of companies doing good, we need to do better about bringing that into the analysis. So one of the first questions I asked you was, where in your company does the power lie? And I gave you a 0 to 2 range. I know it's entirely subjective, but I said, if in your company shareholders have no power, put in a 0. And if your company shareholders have absolute power, put in a 2. So I took the numbers. I think there were 180 people in the class, or 158 people in the class. You break them, no, actually more than that, 200 and something, 20 people in the class. There were 22% of companies where you concluded shareholders had little or no power. Actually, there were 2 people in the class who put in -1. I'm not sure how that falls between a 0 to 2 spectrum. So I'm going to assume that -1 basically puts you closer to 0, and the minus is just not a mistake. But 22% of companies, you said shareholders have no power. In about 46% of companies, you said they have a little power, but in only 32% of companies did you believe that shareholders have significant or more power. Even in the companies you picked, 68% of companies you concluded that shareholders had little or no power in the company. Now, having said that, I also asked you a follow-up question. In your company, who is the marginal investor in the company? And let me go back and give you the definition of marginal investor and why we care. The marginal investor in your company holds a lot of shares and trades those shares. Both conditions have to be met. You think, why do we care? Because we look at risk in your company through the eyes of the marginal investor in your company. And I think almost every company in this class, you picked an institutional investor or an institutional investor with insider influence as your marginal investor. Now, I haven't done the breakdown of this across, but in spring of 2020, when I did this across companies, here's what we saw. If you looked at US companies, most of the companies were institutional. As you went to emerging markets, you started to see individuals and insiders start to pop up more and more. You're far more likely, when you're looking at small emerging market companies, to run into the issue of, the marginal investor in my company is not an institution, it's not diversified, therefore what do I do? You have to think of it more like a private company than a publicly traded company. So that was the first stop. We stopped and looked at where does the power lie, and we concluded that for most companies, the power lies with the managers rather than with the shareholders. Then we got into what I call the meat and potatoes part of corporate finance, coming up with hurdle rates, costs of equity, costs of debt, costs of capital. So let's very quickly review. First, the cost of equity. To come up with the cost of equity, I need 3 inputs. I need a risk-free rate, I need a beta, I need an equity risk premium. Very quickly reviewing, the risk-free rate should be in whatever currency you've chosen to do the analysis in. Doesn't matter where the company is incorporated, your currency choice drives the risk-free rate. If you're in a currency where there is a default-free entity out there issuing bonds, the Swiss franc, the euro, the US dollar, you can use the government bond rate as your risk-free rate. But if you're in a currency where you cannot find a default-free entity, then you're kind of stuck. You have to do a little more work. And if you remember, when I did Tata Motors in Indian rupees, I started with the Indian rupee government bond rate, but I cleaned up to come up with the risk-free rate because I didn't want to end up double counting country risk, one through a government bond rate that included that risk and through a risk premium. So risk-free rate is whatever currency you've chosen to do the analysis in. The beta measures your exposure to market risk. And this is where the assumption that the marginal investor in your company is diversified becomes such a big issue. Because if the investor is diversified, the only risk he or she looks at when they look at a company is the risk you cannot diversify away. Therefore, you focus the beta, which measures that market risk. And if you think about the drivers of beta on a fundamental basis, it's going to depend upon how discretionary your product or service is relative to what people get. So if your product or service is something people can delay buying, defer buying, we argued it should have a higher beta. We said it should depend on your cost structure. The more fixed costs you have as a company, the higher your beta. And we said it should also depend on how much debt you've taken on, because when you borrow money, you create a fixed cost you did not have until you borrowed the money, which is interest expenses. So the very fact that we assume investors are diversified allows us to focus on market risk, and we capture the market risk with a beta. And finally, we talked about equity risk premiums. And I think the overriding theme I try to emphasize is your equity risk premium does not come from where you're incorporated, it comes from where you do business. We looked at revenues, the breakdown of revenues. And it's frustrating because for some of your companies, that breakdown was not very well done, but there's nothing you can do about it. So many companies, for instance, will break the revenues down into domestic and the rest of the world. Again, you wish you had a better breakdown, but if that's all you have, that's what you have to work with. So let's talk a little bit about betas. If you open up any finance textbook, including my own, the chapter on betas gives you this way of estimating betas. Run a regression of returns in your stock against returns on a market index. The slope of the line is the beta. But the problem with the regression betas are multiple, right? And we talked about many of them. First, they're backward looking by definition, because you cannot get returns for the next 5 years, returns for the last 2 years or the last 5. Second, if your company's business mix has changed, even if you look backwards, that regression is not going to be meaningful. And finally, a purely statistical reason. Regression betas are incredibly noisy. You get a big range on your beta. So to counter those, I suggested you look at bottom-up betas, which is basically look at the business or businesses your company is in. And again, that's easier said than done, right? Because many of you wrestled with what businesses to put your company in. And let's face it, many of the businesses we have as breakdowns on reflect the world that used to be. And when you look at a company like Netflix, you're saying, is it an entertainment company? Fundamentally, yes, but it's very different than typical entertainment companies. You have, I mean, I'm not suggesting it's easy, but I think you've got to build from the base up. And I think it's useful to understand the business your company is in. And if you think about how, once you've broken your company down to businesses, we get betas for the company. We get the betas for each business. And some of you, I know, did this on your own, where you downloaded companies in your business. So it's a steel company or an entertainment company, you averaged the beta, you cleaned up the beta. It's a good exercise, but I know many of you also said, look, the beta is already there. Use this beta that you found on my site or somewhere else to come up with the beta. The advantage, the biggest advantage of using a bottom-up beta is it's going to be far more precise than a single regression beta. And it's got nothing to do with finance. It's the law of large numbers. 50 crappy regression betas averaged out will give you a far more precise beta simply because of the law of large numbers. And it also allows you to be forward-looking. If you think your company's business mix is going to change, if you think its debt to equity ratio is going to change, you can then reflect that in your bottom-up beta. Now, I haven't had a chance to read your reports, but I can tell you what I found spring of 2020 when I looked at the betas that were used to do the cost of equity. I mean, I try as best as I can to talk people into using bottom-up betas, but I almost never get 100%. In spring of 2020, 89% of the people in the class used a bottom-up beta. So my sales pitch for the most part worked. About 9% used a regression beta. Now, I know some of you will have used regression betas. It's not wrong. And I can predict the reasons you will give. One is, my company is unique. I cannot find another company like it. I don't know, some of you start with it, say, hey, I have a really unique company. What do I do? And my counter to that, there are no unique businesses. When Google came along, search engine advertising might not have been there, but advertising was always a business. When Uber came along, ride sharing was a new business, but car service had always been there. So one thing to do when you think your company is in a unique business is define your business more broadly. The second, and this is something I don't quite get, is sometimes you get people using a regression beta because their company is in only one business. Remember, my sales pitch for bottom-up betas had nothing to do with whether you were in a single business or multiple businesses. They had to do with the law of large numbers. So even if you're a steel company only in the steel business, I would still argue that a bottom-up beta beats a regression beta. And the third one, and this is something I'm sure many of you wrestled with, is you got a bottom-up beta that was very different from your regression beta. And quite a few of you emailed me when this happened, said, my bottom-up beta is very different from my regression beta. What do I do? And my counter was, if that was never the case, if your bottom-up beta is always going to be close to the regression beta, why would we be wasting our time doing bottom-up betas in the first place? It's precisely because they give you different answers that we do bottom-up betas. And when they get different answers, the statistical argument is go with the bottom-up beta rather than the regression beta. You don't have to go and rewrite any of your report. I'm not going to hold it against you. There's going to be no points lost. But if you use a regression beta, you're going to hear every one of these arguments from people who want you to use regression betas. And I want you to push back. Because I cannot think of a single company where a regression beta is going to beat out a bottom-up beta, no matter how much trouble it is to get that bottom-up beta. Any questions on regression and bottom-up betas? Along the way, if there's any things from the past that is still hanging over your head, you're not quite sure, I mean, we'll hit that topic. So if we hit that topic and you have that question, just throw it out there. No questions about betas? Okay.
Professor?
Yes.
Should we do a 2-year regression or 5-year regression for betas?
That's a good question. If you're doing a bottom-up beta, and let's say you have 50 companies, should you have a 2-year regression and a 5-year regression? You know what my lazy side is telling me? If I have 50 companies, I'm going to use whatever beta the service gives me. If Capital IQ already gives me a beta, the last thing I want to do is go in and recompute it. But Capital IQ does offer you a 2-year and a 5-year average. Right now, I think an argument can be made that you want to use a 5-year average. And I'll tell you why. Usually I'll say it doesn't matter. You know what the last 2 years, the problem is going to be? You're going to have COVID right in the middle. And I'm concerned that COVID would have done things to my risk measures that are probably not long-term. Hotels, I don't know what an R square for a hotel is going to look like. So normally I would say it doesn't matter. But in periods like 2021, we're looking at an unusual year. You might say, I'm going to go with the 5-year beta. But there's a cost, right? When you use a 5-year beta, what's going to happen? You're going to lose some of your companies in your sample because some of them are going to be around only 2, maybe a year and a half. So that's the cost you bear when you go to a 5-year beta, as your sample size gets smaller.
So I did my own 5-year regression. Why is it different than the one in Bloomberg?
If you use a 5, you remember the beta from Bloomberg is an adjusted beta. Do you go and look at the raw beta? Is the raw beta different or is the adjusted beta different?
I guess Bloomberg gives you a raw and an adjusted beta, don't
The
they?
raw beta should be pretty close. It shouldn't be very different if you do the regression yourself. The only reason for the difference, if you remember, is Bloomberg runs the regressions with pure stock price appreciation returns. It does not include dividends. So if your stock had dividends during the period, the betas can be mildly different. Any other questions about betas? Okay. Incidentally, the median beta for a stock in your group was, so just across the companies you picked, the 220 plus companies, the median beta is 1.09, the average beta is 1.17. File that away. The typical company picked in this class was riskier than the average company. I also asked for your Jensen's alpha. Remember, that is, what does Jensen's alpha measure? It's a risk-adjusted measure of performance. It tells you after correcting for the market and correcting for risk, whether your stock did better or worse than expected. So positive Jensen's alpha tells you that your stock did better than expected. A 0 Jensen's alpha basically means you ran in place. And a negative Jensen's alpha means you underperformed the market. Your median Jensen's alpha was about 7%. So let me ask you a question. This I'm going to throw it out to the class. I mean, if you pick 220 companies at random and you computed the Jensen's alpha across the 220 companies, what should you expect to find as your median Jensen's alpha at least? The average can be skewed, but what should the median Jensen's alpha be across 220 randomly selected companies? Gil?
0.
Yeah. So let me ask you a follow-up question. What is it about this class that your median Jensen's alpha is about 7%? That's actually a pretty substantial Jensen's alpha. So why do you think you're getting a positive Jensen's alpha across the companies picked in this class? Gil, you want to follow up? Why do you think you guys ended up with positive Jensen's alphas?
I think we like to talk about and focus on the companies that are doing well.
Yeah, who wants to talk about a loser company, right? We all want to pick winner companies. You know, if you look at the companies you pick, you end up picking. And I contributed a little bit to this, right? Shreya, by doing what? What did I do up at the start of the class when I gave you constraints in the projects that might have led to a Jensen's alpha? So some of you overrode my suggestions.
You suggested that we take companies which had an operating profit, and
one is I said take out the money losers, right?
Yeah.
Then I said take out the financial service companies. And you take out the money losers and the financial service companies, you've taken out a lot of the negative Jensen's alpha companies. So this has always been the case. Every time, it's not the case in the valuation class where I let people pick money losers and money makers, because in this class, I constrain people to pick only money-making companies. You end up with a skew towards positive Jensen's alphas. In fact, the average was almost 40%. Why? Because when you look at Jensen's alphas, you're going to get outliers. I think the highest Jensen's alpha was in the hundreds of percent, a company that basically blew through the top. You know? And essentially, that is not surprising. But so the typical company pick was riskier than average, did much better than average. Then I asked for R squared. And this is a story here that actually, I think, shows you something about what the crisis did. Many of you used 2-year R squareds. I could see that from the numbers. In fact, if you look at by far the highest number of companies at R squareds more than 50%. The median R squared for this class was about 35%. Well above the R squared from last year. I actually went back and compared over the last 15 years. This is the highest R squared I've seen across companies since 2009. Why do you think that is? Why has there been a jump in R squared? Nihar, do you want to try? What happened? What do you think explains the jump in R squared?
Maybe because of the smaller duration that we have taken in regression, that it aligned with the market, like market went up.
Yeah, but that's always been the case. This has been true for the last 15. So it was true last year. Last year, the R squared was only 24%. This year, it seems to have jumped to 35%.
Yeah, that's what in 2020, with market did well and all the companies that we picked, mostly as we mentioned, that also did well, and that could be one of
In other
the
words, in a market crisis, when you know what starts to happen, stocks start to move together. It's the nature of crises. Anytime there's a crisis, you'll see the R squareds go up, which is actually something to think about in investing. In investing, when you have a crisis, everything starts to move together. What you're seeing here is the 2020 effect play out in your R squared. I wouldn't be surprised in 2024 or 2025, when I did this graph, you see the R squared drop back to where they used to be before the crisis. So that's the cost of equity, risk-free rate paid equity risk premium. And while you were doing this project, the equity risk premium kept shifting on you. I know I didn't expect you to keep updating it. But in January 1st, 2021, the number for the US was 4.72%. That number is now down to close to 4%. It's, I think, 4.11%. What happened? Stocks went up much more than cash flows did, and you're seeing equity risk premiums kind of drop down. So any questions on the cost of equity? So once you have the cost of equity, it of course goes into a cost of capital. You bring in a cost of debt, you get weights for debt and equity. But let me emphasize some key issues there to remember. Your cost of debt should be an after-tax cost of debt. So to get the cost of debt, you look at the cost of borrowing money long-term today. It's not a historical cost. It's a rate at which you can borrow money long-term today. How do you get it? Well, if you have an actual rating for a company, you got lucky. You can use the rating and the default spread to come up with the cost of debt. If you don't have an actual rating, then you have to estimate a rating for the company, a synthetic rating. I cheated and used one ratio, an interest coverage ratio, to get that rating. But the end game here is to get a cost of borrowing money long-term. But interest is tax deductible. So you get to a cost of debt, I multiply that rate by 1 minus the tax rate. Jeremy, what tax rate should I use for the cost of debt and why?
The marginal tax rate.
You're right. And why?
Why? Because you told us to always use the marginal tax rate, and even when you say
That's not
effective,
true.
you mean the
That's not
effective
true.
marginal tax
In
rate.
fact, I said you could, when I did earnings in the valuation context, I said you could use an effective tax rate. It's only in the context of the interest expense and cost of debt that I said use the marginal tax rate.
Oh
So
yeah, well that's what
your-
I meant. In the cost of debt, you told us.
Okay.
But
And
I think it's because we need to look at it relative to the, because we're looking at the pre-tax. No, I don't know. Sorry.
Marta, you want to try? Why is it that you got the right, it is the marginal tax rate. So why do we use the marginal tax rate to get the cost of debt?
Yeah, so you use that one because you use a marginal because that's when you get the benefit in the last dollar you earn.
There you go. You got the last interest expense saves you taxes on your last dollar of income. Now, the reason I kind of re-emphasize that is you will run into this argument once you get out there. People say, why aren't you using the effective tax rate? For the cost of debt, we always use the marginal tax rate because interest saves you taxes on your marginal dollars. It's the last dollar of income you protect. So if you have $1 million in income and you have $100,000 in interest expense, you save taxes in the last 100,000. Use the marginal tax rate. Which marginal tax rate? Now, I'm a lazy person. I just use the marginal tax rate of the country you're in, but many of you work with multinationals. And if you truly want to get a marginal tax rate, you might have to figure out where their interest expenses are. But it's, here I just said, use the marginal tax rate of the country you're in. It's not worth the trouble, especially if you have a big US company or European company, to go look at another country's tax rate. That's the cost of debt. And for the debt ratio, there's only one simple rule, which is always use market values. Not book value of equity, not book value of debt, market values. To get the market value of equity, we have a publicly traded firm, easy enough. Share price times number of shares. Michael, if you have 2 classes of shares and one doesn't get traded, when I do market value of equity, should I use just the traded shares, all shares? What do you think?
You should use all shares.
You should always use all shares. If you have multiple class of shares, remember to count all shares because that all goes to market value of equity. Market value of debt is tricky, right? Why? Because most debt is not traded, it's bank loans. And what do investment banks do? They cheat. They use the book value of debt. They wave their hands and say its market value is not that different, so we're going to use book value. But if you remember, there's a simple way in which we convert book value to market values. Way back in the 4th or 5th week of class, we did this. I said, treat the book value of debt as if it's a gigantic bond. Treat the interest expense like a coupon and compute what that book value of debt would trade for today, given today's market interest rate. And pre-2019, I'd have also prodded you by saying, make sure you include lease commitments in debt because lease commitments are contractually something you have to pay. Today, hopefully that prodding is no longer necessary because accountants do it for you. And many of you wrestle with this. Your lease debt is already in the balance sheet. Can I use that? Absolutely. But you're trusting accountants. If you don't trust accountants, you can do it yourself. But the one thing you cannot do is count the lease debt on the balance sheet and capitalize leases yourself, because then you'll be double counting the same debt. So I'm going to show you what the debt ratios you found for your companies were. So these are your actual debt ratios. Now, many of you, when you first started this project and you saw your debt ratio, it was a really low number, 2%, 3%. I remember looking at the emails and you're saying, something is wrong, my debt ratio is too low. Hey, guess what? Looking at your companies, that is actually more the rule than the exception. So let's add one more characteristic to the companies you pick. Not only do you pick risky companies that have done better than the market, you also tend to pick companies that have little debt. All those technology companies that you pick have very little debt. Part of the reason is they shouldn't have debt, and part is inertia. They've never used money, debt. Doesn't mean there aren't companies in your group that don't have high debt ratios, but the median debt ratio across your companies was about 10%. The average was about 18%. Even the 75th percentile was 28%. But let me add a caveat. This is debt to capital in market value terms. It could change overnight. Cody, what could cause the debt ratio to double overnight?
Interest rates.
Interest rates can move it, but it's going to take a long time, right? Think of how much interest rates have to move. What's in the denominator? The market value of equity. Why are debt ratios so low? It's because we've been on this incredible bull market run. If tomorrow's stock prices drop by 40%, all these debt ratios are going to shift out overnight because now you have a much lower market value of equity. So one thing that's a little deceptive about these debt ratios is that debt as a percentage of market value. So if you have a 30% drop in the market, these debt ratios are going to go up. So those are your actual debt ratios. So let's summarize. You got the cost of equity from your beta, cost of debt from your rating, market value weights, you have a cost of capital for your company. Why do we care about the cost of capital? Because it's a rate of return you need to make to break even. Now, I offered you two different hurdle rates. I said, if you're looking at a project through equity eyes, through net income, return on equity, you look at cost of equity. But if you're looking at the entire company and your cost of capital is your hurdle rate, the return you should be looking at is returns to the entire company, returns on invested capital. So for each of your companies, I said, hey, can you try computing return on equity and return on invested capital? And I think more than any other part of the project, this part, which is purely mechanical, gave you more headaches than any other part of the project. Because here are some of the things you ran into. I think for about 15% of the companies in this class, the book value of equity was negative. Dwanish, explain to me how book value of equity becomes negative.
You could have a company that does a lot of share buybacks and pays out maybe too much in dividends to reduce that equity.
Could be one way. What's the other?
Maybe not. Maybe investing too much of it.
Shreya, what else? So you got the first part,
Lots of
which is
accumulated losses
if you
if the
have big
companies.
losses, and you've taken restructuring charges, and many companies in 2020 took those charges, your book equity turns negative. The minute your book equity turns negative, your return on equity becomes not meaningful. In other words, you can't take your net income, divide by the book value of equity, and tell me you have a negative return equity. That would make no sense. So if the book value of equity turns negative, your return equity becomes not meaningful. For about 5% of your companies, return on invested capital became not meaningful. You know why? Because the cash balance of the company is actually greater than the book value of equity and debt. Your invested capital itself turned negative. Now remember, this is a means to an end. When you look at a return equity or return invested capital, you're getting a backward-looking number. You're trying to, as best as you can, gauge whether your company earns more than its cost of capital. So I'm going to have one more characteristic to your typical risk in company, which is already risky, doing better than expected, has a low debt ratio. The median company in your group across the 220 companies earned about 6% more than its cost of capital. Again, it goes with your selection bias, right? You're picking winners, you're picking companies that do well. Not surprisingly, those companies earn above their cost of capital. About 30% of your companies earn less than your cost of capital. The 25th percentile was minus 2.8%. So there are companies that earn well below their cost of capital. Does that mean that they are bad companies? Not necessarily. So Brian, I'm going to put you on the spot. You have a company, it's earning less than its cost of capital. What are the conditions under which this company might not be a bad company, where you cut it some slack and say, that's okay?
Yeah, future growth prospects.
One is if you're a young company where everything lies in the future, you're just starting to make money. It's a little unfair to ask you to make more than your cost of capital, right? Because you're just building up. The second is if you're an oil company, 2020 was a bad year, not because you're a bad company, because oil prices dropped to $30 in March, you might earn less than the cost of capital. The return on capital measure has taken on this life of its own, and consulting firms and banks, people worship this number. But remember, it is an accounting number. It comes with a whole lot of caveats, and that's one of them. So we've talked about the cost of capital. We talked about the return spread in accounting return from an accounting return perspective. Then I asked you to compute the optimal debt ratio. And it's true. I squeezed you through my spreadsheet. So some of you saying, I didn't compute it, you did. Okay, I'll take on the responsibility for doing that. But here's what you found as your optimal debt ratios, with the caveat that this is my spreadsheet yielding the output. If you look across companies, the median optimal debt ratio was about 10 to 20%. So it's not just that your companies that you picked have low debt ratios, they can't afford to have very much debt, 10 to 20%, again in market value terms. But there are a few firms, the optimal debt ratio is 60, 70, 80, or even 90%. And you know what's going to divide those companies? It's growth. So if you're a growth company, I'll wager you're way down on this side of the spectrum because your market value is getting pushed up. You don't have the income. More mature companies, where your bulk of your growth is behind you, are more likely to have higher optimal debt ratios. In fact, what you found in terms of actual versus optimal debt ratios is I think your median company was pretty much on target. The median, so this is the difference between the actual and the optimal debt ratio. Your median company actually was slightly over-levered by 2%. So many of you found your companies pretty close to your optimal. There's a reason for that. That seems to be pretty much a pattern, is right now companies are pretty close to where they should be. Presumably using a 21% or a 25% tax rate for the US. I'm not sure what this will look like next year if corporate tax rates go up to 25 or 28%. But for the moment, at least, the benefits of debt seem to be not that substantial. And companies really shouldn't be borrowing a lot more money. Any questions on the actual versus optimal? So when you look at the change in firm value you get from going to the optimal, it's either non-existent or for some of your firms, even negative, because you're already closer to your optimal at the existing debt ratio than at the optimal debt ratio. Once we got the optimal debt ratio behind us, I said, what's the right kind of debt for your company? Okay. And I said, do it intuitively. I didn't ask. In fact, for many of you, I steered you away from that macro regression saying the numbers are going to be all over the place. Try it. If it works, use it. If it doesn't work, don't spend too much time on it. Intuitively, what you're trying to do is design debt that behaves like equity. Gives you all of the tax advantages of debt, but essentially has the flexibility of equity. So the cash flows go up when your cash flows are high as a company, and the cash flows go down when you're doing badly. Of course, I did run those regressions. One was against interest rates to get a measure of how much duration, how long-term your assets were, against GDP to get a sense of how cyclical your company was, against inflation to see how much pricing power you have, and against exchange rates to see how much you're affected by the dollar. Again, there's no rocket science here. I'm trying to get the numbers to give me some information I can use in designing debt that better matches your company. And then we turned to dividend policy. And the key number when you look at dividends and buybacks is how much could your company have paid out in dividends? That free cash flow equity number. Again, let me give you my intuitive explanation for what a free cash flow equity is. You start with the net income of the company because that's the equity income. You add back depreciation and amortization, of course, because they're non-cash. You subtract CapEx because you've got to give the cash out. You subtract changes in working capital. If you have preferred dividends, you pay those out. In other words, you pay everybody who has a claim on the firm, and whatever's left after you've met every claim on the firm is your free cash flow equity, your potential dividend. And I warned you, this number will jump around. It'll jump around because your income jumps around, your CapEx jumps around. It can go from positive to negative. And I said, please don't do it on 1 year because who knows, especially what 2020 would have delivered or 2019, look across time. And then I asked you to compare what your company paid out in dividends, but I said, don't just stop there, look at buybacks as well, and compare what dividends and buybacks at your company were relative to free cash flow equity. And I was surprised because in your companies, there were a few firms, about 17 firms that paid out more than their free cash flow equity. But 85% of the companies in your project either paid no dividends and had no free cash flow equity, which is fine, or paid out less than their free cash flow equity. So if you want to add another characteristic to the companies you pick, they tend to be cash accumulators. They tend to build up cash in the company. So if you saw a big cash balance in the company, this is what's driving it. Your dividends and buybacks are less than the free cash flow equity. And across the 220 companies, I think at least 70% of the companies had buybacks in addition to dividends. There were very few pure dividend paying companies. It was dividends and buybacks. And of course, that brought us to the last week when we talked about valuation. And I said, you know what, I'm not going to kind of hold your feet to the fire in the valuation. It came to the very end of the class. It might not have been the way, you might not have had the time to spend on it. But I presented two ways you could think about valuation. The first is to focus on the equity of the company. Get cash flows to equity, either dividends if you're lazy or free cash flows equity, and discount them at the cost of equity. Come up with the value of the equity. Or I said, look at pre-debt cash flows, which is free cash flow to the firm, where you start with after-tax operating income, subtract out reinvestment, and discount free cash flow to the firm at the cost of capital to come up with the value of the operating assets of the company. So I'm going to go in because there are a few loose ends I left on valuation that I want to tie up now. So I'm going to go back to the lecture notes at the third packet, the pages that I didn't cover, and cover them here. Let's think about what you do after you've taken the present value. If you've done a dividend discount model, you discount dividends back at the cost of equity, you're done. There's nothing to add, nothing to subtract. That is the value of your equity. If you discount free cash flow to equity at the cost of equity, you valued all of the equity in the company. And then you got to think about not just your claims as shareholders, but other claims. So there are equity options that managers own. You got to net that out, but still just one adjustment. But when you take free cash flow to the firm and discount at the cost of capital, you come up with the value of the operating assets of the company. And let me explain why. Think of what we started with to get to free cash flow to the firm. It was operating income. I have valued only those assets that are part of operating income. So what have I not valued? I haven't valued cash in the company because interest income from cash is not part of operating income. You know what else I haven't valued? If you own 3% or 5% of another company, I haven't valued it because that's treated by accountants as a minority holding, and the income from that holding shows up below the operating income line. I'm mopping up. Whatever I haven't valued yet, this is my last chance. I'm going to add those on. When I add that on, I come up with the value of the entire firm, operating assets plus cash plus these minority holdings. But remember, I'm interested in just the equity of the company. So I subtract our debt, obviously including leases, to come up with the value of equity. And then I do a last stop. I say, are there other claims on my equity? If I've given options to managers, they have a claim on my equity. So I'm going to value those options and subtract them out to come up with the value of the equity in the common shares. And then you divide by the number of shares, you get the value per share. Now, of course, to get the value of the operating assets, you've got to make assumptions about growth and margins and reinvestment, but this is the end game to come up with the value of equity. So I'm going to do a couple of valuations that I'd kind of left out of, from the third packet to kind of bring this home. Remember I told you I valued Deutsche Bank in 2008 using a dividend discount model. Dividend discount models are nice, they're clean, there's very little mopping up to do. But they come with a consequence, which is you're trusting managers to pay out what they can afford to in dividends. And in 2008, before the crisis, I was in that position of trust. So I decided to value Deutsche by discounting dividends. So here's what I did. I projected out the net income for the next 5 years. I still have to project growth in earnings. I assumed that they would pay out what they were paying out as a percentage of net income. So 54% every year for the next 5 years. So I've got net income projected out. I project dividends for the next 5 years. I get expected dividends every year for the next 5 years. So the dividends are growing at the same rate as net income. And then I discount those dividends back at my cost of equity. Why cost of equity? Because dividends are cash flows to equity. And what I get as a present value of just the dividends for the next 5 years is 9.65 billion euros. You're saying I'm done? Not so fast. This is just the dividends for the next 5 years. What happens after year 5? Deutsche Bank continues. And as it continues, the dividends continue as well. But I'm going to make the assumption that after year 5, Deutsche is going to grow. No, Deutsche's dividends are going to grow at 3% a year in perpetuity. Basically, a growth rate less than the growth rate of the economy. So here's what I'm going to do to get my value at the end of year 5. First, I'm going to say my growth rate is going to drop to 3%. I can't keep the payout ratio what it is because my growth rate is going to be much lower. And I'm going to assume that I can make an 8.5% return in equity forever. With 3% growth rate with an 8.5% cost of equity, I can afford to pay almost 65% of my earnings every year forever. What I'm trying to bring home here is when you make your company a mature company, I must make sure that everything about the company reflects the fact it's a mature company. And because its growth rate is low, its payout ratio is going to be much higher. So I'm ready to value the stock at the end of the 5th year. I take the expected net income in year 6. This might seem like nitpicking, but in discounted cash flow valuation, to get to a terminal value, always use the cash flows in the year after your final year, in this case, year 6. And I use the 64.7% payout ratio. Gives me dividends in year 6. That's forever. Growing at 3%, I get 62.3 billion euros as my value for equity at the end of year 5. So I've got my expected value of dividends for the next 5 years, the value of equity at the end of the 5th year. I discount that terminal value back to today using the cost of equity for the first 5 years, because I've got to live through the first 5 years to get to my terminal value. The value per share that I got was about 105 euros per share. Stock was actually trading at 89 euros. Based on a dividend discount model, the value I would attach to Deutsche in 2008 would have been 105 euros. Thank God I didn't buy the stock based on this valuation, because it would have been one of the most horrific mistakes that I've ever made. But in a pure dividend discount model, all you do is project dividends out, discount them back, and once you're done, you got the value of equity. So I'm going to finish my Disney valuation since I've talked about Disney so much during the course of this class and talked about how the objective in corporate finance is to maximize value. Might as well tie up the loose ends and actually value Disney as a company. So I'm going to list out my assumptions. And as I list out my assumptions, you're going to see me bring in what I've already learned about Disney over the previous 13 weeks. So remember I said for Disney, I'm going to give them 10 years of growth, but don't get too excited. Not really high growth, but just above the growth rate of the economy. Why? Because I think they still have some growth potential left in them. So I'm going to allow for 10 years of growth, but I'm going to break that 10 years into two phases. The first 5 years, I'm going to keep the growth constant. And after year 5, I'm going to call this a transition period where I adjust things down to what I think Disney will look like as a mature company. So let me focus on the first 5 years. Because in this valuation, the story I'm going to tell for Disney is a status quo story. What does that mean? I think Disney is going to continue to be run the way it has. Why? Because they've been pretty successful. So for the next 5 years, I'm going to assume their effective tax rate is going to stay at where it is today, 31%, and their marginal tax rate will be 36%. If you remember, I computed a return on capital of 12.6% for Disney. I'm going to assume that that's going to stay the return on capital for the next 5 years. And for the next 5 years, I'm also going to assume that they will continue to reinvest the way they have in the most recent year. If you remember, the reinvestment rate I computed for Disney was about 54%. You take 54% reinvestment rate, 12.6% return on capital. Remember, I said don't get too excited. The growth rate is not that high. It's about 6.8% a year for the next 5 years. My debt to cap ratio stays at where it is. Why? Because the existing management run the company. I might believe that Disney can afford to carry more debt, but I don't run Disney. Bob Iger does. So I'm going to leave the debt ratio where it is. So for the next 5 years, just more of the same. They're going to continue to do what they're doing, growing at 6.8% a year with a 7.81% cost of capital. Now, by the time I get to year 6, I'm way out in the future. So rather than deal with year 6, I'm going to do something very weird. I'm going to go to year 11, which is when I'm a mature company. And I'm going to give Disney the characteristics of a mature company, a much lower return on capital, a reinvestment rate that reflects the lower growth rate of 2.5%, a debt to cap ratio closer to the optimal, but not all the way to 20%, and a lower cost of capital of 7.29%. So for the next 5 years, I have 6.8% growth. After year 10, I have 3% growth. For the next 5 years, I have a 7.8% cost of capital. After year 10, I have a 7.29% cost of capital. You're saying what happens between year 6 and 10? I move the numbers gradually. So to get from 6.8 to 3%, I go in 5 steps down to 3%. To get from 7.81 to 7.29%, I go down in 5 steps. So my growth rates and cost of capital just step down. So here was my November 2013 valuation of Disney. And as you look at this valuation, it looks like a lot of new numbers coming at you, but every single number in this valuation comes from something we've already done before. My reinvestment rate and return on capital reflect what Disney did in the most recent year, which gives me my growth rate. My cost of capital comes from the risk-free rate of 2.75%, which is a US dollar risk-free rate, because I was doing my analysis in dollars. My bottom-up beta, 1.0013. If you remember, that's from building up the 5 businesses they're in and their existing debt-to-equity ratio. The equity risk premium for Disney reflects the fact that they get 82% of the revenues in the US, 18% of the rest of the world. In other words, I'm just taking numbers I've used along the way to come up with the cost of capital and a growth rate. I project the cash flows out for the next 10 years. At the end of the 10th year, I put them into stable growth. And if you remember, the growth rate I gave them was only 2.5%. I put in the lower growth rate, come up with the terminal value of 165 billion. That's at the end of year 10. Discounted all back to the value of my operating assets. It was 125.5 billion. I had cash. I had one minority holding. Disney actually owns 49% of Hong Kong Disney. At 2013, Shanghai Disney hadn't opened because the Chinese government had insisted that they keep the majority stake. So Disney was actually reflecting Hong Kong Disney as a minority holding, 49%. That's a 2.85 billion that you see there. I subtract our debt. They also were consolidating some holdings, especially I think that TV company in India that they owned majority stake in. Minority interest reflects the portion of those companies that doesn't belong to Disney. So it's a 45 or 30 or 35% that doesn't belong to them. But the bottom line is the value that I get for the equity is 113.6 billion with the status quo running the company. They did have some management options outstanding. So I value those options as options, basically reflecting the remaining life, the standard deviation, divide by the number of shares. The value per share that I would get in November of 2013 was $62.56, but that's completely false precision. It's about $60 to $65. The stock was actually trading at about $68. If you force me to take a stand, I'd say it's slightly overvalued, but not by enough for me to go out and do anything crazy. But every number in this valuation comes from a previous page. I could actually list the page number, and you could see it in lecture note 1, packet 1, page 76, page 95. I've just collected numbers I've used along the way in corporate finance to actually value the company. So it's true, it's a little unfair. I did ask you to value your companies, and you did, and I'm thankful you did. So let me show you back what you found. The median company in this class was overvalued by about 28%. The average was about 73%. So there are some really, really overvalued companies. In fact, 73.5% of the companies in this class came out as overvalued. 26.5% came out as undervalued. What does that tell me? If I believe you, I should be selling stocks collectively because this is a sign that you think stocks are essentially overvalued. And I know some of you in my valuation class, I'm going to show you what that class found as well. And I'll give it away. The valuation class where the entire focus was on valuation was roughly the same. About 70% of the companies came out as overvalued. 30% came out as undervalued. That's the highest overvalued percentage I've seen in these classes since 2008. Now take it for what it's worth, but most of you found overvalued stocks. One final point though, as you look at your valuation, you could probably ask the question, can I change this value? And the answer is absolutely. In fact, when I think about corporate finance is about changing value. And how do you change value? By changing the levers that drive value. Think about some of the things you can do. You can grow to create more value by either reinvesting more if you can earn more than the cost of capital, or reinvesting less if you're earning less than the cost of capital. You can change the mix of debt and equity, change your cost of capital, come up with a lower cost of capital. Maybe you can build up your competitive advantages to pull out your growth period for a longer period. In other words, what you see as a DCF value reflects a view of the world. And if you change that view, you can get a very different value for the company. Dan?
I guess I have two questions that probably everyone's asking. The first would, do you think are the MBA students are good stock pickers, or are we risk takers?
You don't have to be. It's the law of large numbers, right? Each of you could be badly wrong, but there is still information in the cross section, right? If you're wrong, you're going to cut in both directions. If you're biased, you're going to cut in one direction. And if you find overvaluation, undervaluation, you're finding the mistakes in one direction. So that's why I look at the proportions across classes, because it's not an indication of is the single valuation. When I want to pick a stock based on evaluation, then I have to ask the question, how much do I trust the valuation? So here I'm just looking at the cross section. And that cross section suggests that at least based on the numbers as they stand today, more of you are finding your companies overvalued than undervalued. And even if every one of your valuations is noisy, has error in it, that statistic is the one that I'm focusing on.
And my second question, I guess, would be, when you see massive overvaluations like the ones you're seeing, do you normally witness a huge sell-off somewhere in the next year or so? Or no?
I'll hold it off to my valuation class, because obviously it's not fair to do this in the corporate finance class. It's the end of the class. People's heart is not in the valuation because you have other stuff to do. My valuation class, I'll actually show the results of what's happened over the last 30 years because I've kept track of what the classes have found and what the market does in the subsequent period. I also have it on individual stocks, most under overvalued stocks. But for this class, I'm going to kind of pass on that because I don't think it's quite fair to hold the valuation part of the class up to the scrutiny that I would if you were spending the entire semester on valuation. So let's think about changing Disney's value. Because remember, when I valued Disney, I valued it with the status quo. But along the way, through the course of the class, there are things we suggested Disney could do differently. Like what? We did suggest that Disney could borrow more, right? Remember when I did the optimal debt ratio for Disney, the optimal debt ratio was 40%. They were at 11.5. I said, if somebody else ran Disney, maybe they could use a higher debt ratio. What does that do? It lowers their cost of capital. Disney's reinvestment rate is about 54%, and the return on capital was about 12.7%. If they were a little more finessed in their investment, if they could reinvest the way they used to, at least in some businesses, I think they can tweak their growth rate, not to push it up, 6.8 to 7%, slightly more value from higher growth, substantially more value from a different debt ratio. The value I got with the status quo is 62.56. With those two changes put in, a higher debt ratio and slightly a higher growth, the value that I get per share is about $75. So value with the status quo is $63. The value with somebody running it better is $75. Mallory, what should I call that difference? I have two values for the company, 63 with the status quo, 75 with changes put in. What should I call that $12 difference?
I'm not sure.
Well, it'll come about only if you run the company, right? And so the existing management, only then can you make the change. In other words, you will control the company. You'll often hear in finance this term control premium, value of control. You've just estimated what the control premium at Disney would be. It's about $12. In fact, if Disney were already perfectly managed and perfectly run, you know what you're going to find, right? Alex, if Disney were already perfectly managed and perfectly run, what should the relationship between those two values be? I can't hear you. Sorry, you're still muted. Oh,
Yes, I'm not sure.
So the status quo value will reflect perfectly managed, perfectly run. Then I'm going to ask you, what will you change about the company? If it's already perfectly managed and perfectly run, you say nothing, in which case your optimal value is going to be equal to your status quo value. The value of control in a perfectly managed, perfectly run company is going to be 0. I know some of you were working with some companies that you thought were horrifically badly run. The value control can be huge at those companies because you can change the companies. Don't let people tell you that control premiums are worth 20% or absolute numbers. It really depends on the company. And truly value control premium, you need to understand corporate finance, not valuation, because you need to know what levers you're going to change. What are you going to change about this company that will make it a more valuable company? There's one final run through I did of your numbers. Now, remember, I asked you whether your company was under-levered or over-levered, and you made a judgment. Then I asked you, does your company pay out what it can afford to in dividends, and you made a judgment. Then I asked you, is your company undervalued, and you did. I'm going to give you a list of what I call my triple whammy companies. These are companies that are under-levered, are not paying out what they can afford to in dividends, and are undervalued. You know why I call them triple whammy? If you are going to acquire a company, this is your dream combination, right? Think of why. If you buy a company that's undervalued, you already have a little buffer built in. So you're buying an undervalued company. It's under-levered. So what can you do? You can actually borrow money to do the acquisition. And remember, they've been paying out less than they can afford to, so they've built a large cash balance. I'm not suggesting that these companies are all going to get taken over, but these companies all have the ingredients that you would look for in an acquisition. So you've got Danone, which is a French company, and how easily you can do it, maybe a family-controlled company. But one thing to do, if any of you are doing these companies, is look at their corporate governance. And if you believe that there are no barriers to somebody coming and acquiring the company, this would be a good bet to make. Invest in the company. You're investing not because you think change is going to come tomorrow, but because you think a Carl Icahn or a Bill Ackman will target these companies and you will benefit from the change that accrues. So back to a page we started the class with. I said, corporate finance, about 3 principles. Let's review the principles. And hopefully by now we have enough substance to put some meaning behind the words. First, you have the investment principle. Yeah, go ahead.
Before you move ahead, I just have a question on the debt Disney valuation page.
Yeah.
Could it, so for example, for the expected growth, what if you have a company where your expected growth is lower than the long-term risk-free rate, and then it's like you go?
Yeah, but
I guess,
remember, if it's under-levered and you don't have good projects, how would you get to the debt ratio? Remember, you don't have to borrow money and take projects, right? What would you do with the borrowed money if you don't have good projects?
you return it back to, I guess, you return it
buy
back
back
to
stock.
shareholders.
So this is a separate issue from whether you have good projects. If you have good projects, you borrow the money and take projects, right? So if it's the case of Disney, I think they have the potential to earn more than the cost of capital. I'd say, okay, go out and borrow money and take the project. But if you didn't have good projects, I'd say borrow the money, buy back stock, shrink your company. That's effectively what you're doing. I mean, that's what Coca-Cola has been doing. Michael actually, in the last class, they're returning more cash that they can afford to. They're shrinking as a company. And in a sense, they're signaling the best days are behind us. We're not going to force this money back in the company. And that's a sensible thing to do. Any other questions? Okay. So let's review. Investment principle says go out and pick investments that earn a return that is greater than your minimum acceptable hurdle rate. So as I give you the sub-principle, I want you to think about the underlying tools we use to do. When we talked about hurdle rates, we said the hurdle rate should be higher for riskier investments, right? Think of how we define risk. With equity, we define it as risk you cannot diversify away and measured with a beta. And with debt, we measured as a default risk with a default spread and a cost of debt. So the hurdle rate reflects the risk of the investments through those 2 measures, risk premiums and default spreads, and should reflect the mix of debt and equity that you use. The cost of capital weights are the mix of debt and equity. The hurdle rate reflects the risk and the mix. Return should be based, we said, on cash flows. In a perfect world, what would we do? We'd project out the cash flows on projects. We'd compute the net present value. If the net present value is greater than 0, using the hurdle rate as the discount rate, we would take the project. If we don't have access to that information, then we cheat. We use accounting returns as shortcuts. And remember, they're shortcuts, looking at the return on capital and return on equity to make that same judgment. Take good projects, invest in projects that earn a return greater than your minimum acceptable hurdle rate. Turn to the second principle, the financing principle. Go out and find a mix of debt and equity that minimizes the hurdle rate. That's why we went through that exercise of changing the debt ratio and seeing what it does to your cost of capital. And try to match the debt you have up with your assets. Long-term debt with long-term assets, rupee debt with rupee assets, dollar debt with dollar assets. And if you have pricing power, make it floating rate debt. And in the dividend principle, we said, don't force the issue. We cannot find investments that make the hurdle rate. Give the cash back to the stockholders. Whether you do it in the form of dividends or buybacks depends on what kinds of stockholders you have as a company. If you have the kinds of stockholders who like dividends because you have a history of paying dividends, then pay more in dividends. If you have a history of never paying dividends, use it to buy back stock. Investment principle, financing principle, dividend principle. And in all of this, you have a singular objective. You want to maximize the value of your business. Everything that you ever run into business is somewhere in there. And you have to make a judgment of how to find a place to put it in. So early in the class, I think in the very first class, I listed my objectives. I'm not sure I'm even close to them, but I'll list them back again. I mean, the objective of this class was to give you a big picture perspective of everything businesses do, how they fit together. I mean, along the way, we looked at lots of tools, right? Remember not to mistake tools for principles. The CAPM is a tool. Measuring risk is a principle. You might not like betas, but you still have to think about how do I bring risk into discount rates. There are lots of tools in corporate finance. Don't let the tools run you. Excel is a tool. Models are tools. You ultimately make the judgment. I mean, the number crunching is the easiest part of corporate finance. In fact, I have a version of a spreadsheet which I've built, which I don't put out in public, where if you enter all the numbers from your 10K, it'll do all of your corporate financial analysis automatically. It does everything from investment analysis, and you can see why, right? Because everything draws on that raw data. So you're saying, why then have a class if a spreadsheet can do it? Because once I get the optimal debt ratio for my company, guess what I have to do? I have to make the judgment on whether I want to move to the optimal, whether this is the kind of company where I'm going to leave the company alone, say it's okay to be under-levered. Oh, I mean, this isn't automatic. If it were, we would not need people doing corporate financial analysis. And my third objective was actually to try to make this fun, but this might not be the right day to talk about corporate finance being fun. I might be ripping scabs of recently developed wounds. But somewhere, sometime in the future, you might look back and say, it wasn't too bad, I can do that. And if you really want to get better at corporate finance, just do it. I mean, there's no more to read. This is it. There is no extended reading, no additional classes. Everything past this is just application. Pick a company very different from the company you analyzed in your project. You now have the template, take it through the process. Then pick another company. And with each company you pick, you're going to find things that are new and different. And that's how you will learn to deal with them, is by going back to first principles. What should I do in this company? And so the more you work with companies, the more you will get comfortable with the tools and the power you have sometimes to override those tools and say, look, that tool doesn't work here. I'm going to make a different judgment. So final reminder is I think your CFEs open up tomorrow. So I just want to remind you, because the reason I do it is for a purely selfish reason. You know what happens if you don't do your CFE? Ryan, do you know what happens if you don't do your CFE?
We don't get
your grade.
You can't check your grade. And you know why I care about that? Because when you can't check your grade, guess who hears about it? I will get an email from you saying, I can't get in to check my grade. Can you please send it to me? And the more of you finish the CFEs, the less of those emails I get. So frankly, I don't care if you go in and destroy me on the CFE, just get it done, get it out of the way. And as you finish up, it takes only like 5 minutes, right? There's a high correlation between. So if you pick ones for everything, just pick one all the way through. It's quicker. So, whatever you do, just get it done with, because that way when the grades come out. Final thing is your final exam is a week from today. And as with the quiz, I am going to give that option of an open-ended final for those of you who felt more comfortable with that version. So I'll put out the Google shared spreadsheet for that, so you can go in and sign up for the open-ended version. But you will hear from me over the next week. I'm not going to let the nagging end till the very last day. So you will hear from me about the final and things to kind of, the I's to dot and T's to cross. But I'll see you then. Take care and have fun this summer. Bye.
Thank you.
Thank you.
Thank you, Professor.
Thanks, Professor.
Thank you,
You're welcome. Take care.
Professor.
Thank you.
And I'll see. And one more thing, I will see you perhaps next spring, because I teach only in the spring in valuation, if you feel like doing it. But if this is all the torture you could take, and that's why I said the torture ends was the title of your final project being done. I won't take it personally. If you said never again do I want to sit in on a class in finance, I'm okay with that too. See you soon. Take care.
Professor Demoderan,
Thank you, Professor.
Yes.
I have a clarification question. So for what I was talking about for the Disney was that the reinvestment rate times the return on capital was 7.8%. And
you said, why did they reinvest more, right? Is that what you're asking?
No, but the long-term risk-free rate was 2.5%. What if you run into a situation where the return on investment capital times the investment rate is lower than
then you can use a lower number. right? So
Okay.
you set the growth rate in perpetuity. It's not automatically set. So
Yeah.
you can set it at 2.5, 1.5, or even a negative number. If you're valuing ExxonMobil, you can actually assume the growth rate in perpetuity could be a negative number.
Okay. Awesome. Thank you.
Kushal?
Professor, first of all, thank you for a really good semester. I had a question on the optimal debt ratios as we were going through it today.
Yeah.
Based on how you have the spreadsheet set up, are there certain companies or certain types of companies where you see the optimal debt ratio being greater than like 50%? Because that seems so rare.
Anytime, I'll tell you the key number is if you take the EBITDA for your company and divide it by the enterprise value. In other words, how much they generate is, the higher that number, the more debt you can afford because the debt has to be serviced with cash flows. So mature companies which are throwing off huge amounts of cash flows relative to their market value will have high debt ratios. That's why you get much lower debt ratios. If you do an Apple or a Facebook, they have huge cash flows, but as a percentage of their enterprise value, that number is still a low percentage. So you need a combination of high cash flows and low enterprise value, which is one reason LBO guys actually do the inverse of that as a way of finding good targets. EV to EBITDA, which is the inverse of the ratio that I talked about, has to be less than a certain number for a company to be a good target in an LBO. But it's all about cash flows relative to total value. That's what's going to drive your optimal.
Got it. Okay, thank you.
But there are two things to factor in. One is, the equity risk premium drifts down. Equity is getting cheaper relative to debt. That's going to push down the debt ratio for every firm, right? So there's a macro factor as well, which is we're in a world with low interest rates and low equity risk premiums. It's going to push down the optimal debt ratios for many firms because equity is cheap.
Right. Okay. Thanks.
Shreya?
Yeah, Professor, could I, first of all, thank you for a lovely semester. And also, could I very quickly get your opinion on whether or not it's okay for me to put this in my report? I discovered that the company that I'm looking at for our CF project is majority owned by the Chinese government. And there's another institutional holder in this company, which is also majority owned by the Chinese government, but it holds a very tiny stake, like 0.3%. And it's a life insurance company that has been purchasing shares every year for the last 4 years. And I worked at an AMC in India, and when we saw the LIC do this, the traders told us anecdotally that it was a sign that the government was buying shares to push up the prices of its own companies.
Right.
I don't have any proof of this, and I don't have a lot of information to back it up, but it is something.
When you did the cash flows, did they have the cash flows to cover the buybacks? Because it's possible that
It's not a buyback. I have another.
Or they're just buying shares.
They're
from the
just
company
buying shares to keep the prices up.
That's entirely possible. Right? It's
Yeah,
entirely
I know it happens, but if I phrase it gently, is it all right for me to add something that's speculative in my report?
Absolutely. In fact, the entire report, in a sense, is speculative, right? So it's because you're making judgments based on observable data. So in a sense, that's perfectly okay. So if you feel that based on what you observed, that it's also a big part of your corporate governance. It's a huge part of corporate.
There is actually another corporate governance issue, which I'm having a little trouble just articulating. Yeah. So I discovered that the CEO and the chairman are both members of the Communist Party, and the CEO reports to the chairman, which I find.
Well, I think the bottom line is this is an extension of the Chinese government. End of the story. So there's nothing more. It's really, once you say that, everything else is just part of that story, right? Because that comes out of the story. If you believe the government is essentially the power behind the company, the CEO is going to be connected to the government. The board of directors are going to be composed of people the government wants on the board. So in a sense, all the protective mechanisms are now gone. Does it mean you shouldn't buy shares in the company? No.
No, it's doing brilliantly.
You should buy shares with the recognition that you are now unofficially a partner, a very junior partner of the Chinese government, and God help you if you and the government fall out. I mean, this is the Alibaba case, right? You're on the right side of the story. This might be even bigger because the Chinese government itself is a shareholder, so that's perfectly okay.
All right, thank you very much,
You're
Professor.
welcome. See you. Go ahead, Nate.
Yeah, I have a question about cost of equity, cost of debt, cost of capital, how you
Yeah.
say they're currency dependent. How do how do the units for that work sort of? So like the units are in like percent dollars, I guess, or percent whatever currency you're in.
Yeah.
This question might not make sense, but like, so like your cost of debt, it's in a, to me, when you have a percentage that's unitless, I guess that's how I think of it. But like, how is it in percent dollars?
Because if you borrow in Venezuelan bolivar, what rate do you think you'll get from a bank? Let's keep it simple. Let's say you're a company, you go borrow in Brazilian reais. As
Probably a
opposed to
high
US
rate
dollar. Yeah, and why is it going to be higher?
because the currency is more volatile.
No, it's because inflation is much higher in those currencies. Nobody will lend to you at a rate lower than the inflation rate, right? So if you have a 30% inflation rate, I don't care how good your credit standing is. When you borrow money, the person charging you an interest rate is going to make sure they get inflation back. High inflation currencies. So that's why the place it shows up is through the risk-free rate, right? So the risk-free rate is the vehicle for breaking in inflation. So when you borrow in one currency as opposed to another, even if it's the same company at the same point in time, you pay different rates. The lower rate is not always better than the higher rate, because borrowing money in a lower rate currency with less inflation might actually be more expensive than borrowing money at a high rate. A Turkish company borrowing at 10% in reais is actually getting a much better deal than that same Turkish company borrowing at 6% in euros, because the lira has a much higher inflation rate embedded in it. So they're percentage rates, but the percentage itself is going to depend on what currency the underlying equity or debt is denominated in.
Okay. Is there like a technical way to present that? Like if I say my risk-free rate is 2%, is it like percent dollars? Is that the way to say it?
No, you never have to say percent. But you have to specify my loan in dollars. So you're always, whenever you talk about a rate, and this is a good point I think you're bringing up, you always have to specify the currency in which you're going to be talking before you specify the rates. So if a Turkish company says my cost of capital is 11%, the first question I'm going to ask them, in what currency?
Okay.
Without it, I can't say 11% high number, low number. So that's why you can't respond to a percentage number without knowing what the currency that goes with it is.
Okay. All right, that makes sense. Thank you. It's something I thought of recently I wanted to bring up. All
Okay.
right. Yeah, thanks for a great class, Professor.
You're welcome. Jonathan?
No, just listening to all the comments this
Okay.
morning and everything. Thank you very much for the class, Professor. I learned a lot,
welcome.
and it was really a very eye-opening experience about finance for me.
Thank
So,
you. I'll see you in
very much.
valuation class. Take care.
Yes, take care.